Ladies and gentlemen, this is Forex Basic Forex. I will be talking about Forex and the business of Forex trading. So what is Forex? Forex, like I said, is nothing but foreign exchange, whereby currencies of nations is traded for another at a mutually agreed rate. If I want to go back to the history of Forex, the history of Forex is dated to the 16th or 14th century. In Africa, for instance, what we do then was more or less what we call trade by barter. When one good or farm goods or produce is exchanged for another, like somebody has yam but is in need of cassava, so you trade your yam for the cassava. But it got to a time that I might have yam and in need of your cassava, and you might not need my cassava. So how do I still trade? So they got to a point whereby they started using cowries. They use cowries as a medium of transaction. So they say, okay, your yam worth this much in cowrie, so you give me cowrie, I give you my yam. So, and if I need something, I go elsewhere. Perhaps I need a goat or I need beans. I can trade like that and use my cowries as a means of legal tender. That is what we do in Africa until we have coins or naira being introduced. But between nations, when a nation has to trade with another nation, a whole lot of volume is being needed. And at some point, they were using US gold, because US has almost like 2/3 of the world gold was in US at that point in time. So everybody was using gold as a means of transaction. And the earliest was to start using weighted coins, weighted gold coins. They weight it, say, oh, it means this much. So you carry your coins, you give in exchange for whatever produce you want in another nation. But that also has its own problem and limitations. Over time, the gold coins begin to rub on each other because they weigh it. It will reduce the weight and value. So it became a problem. Until later, Japan came up with a paper IOU. And this was being used widely because paper was very light. And you can put paper together and say, okay, oh, I have this much gold in exchange for your goods. But that also hit a brick wall during the Second World War. Some people were printing fake money or fake IOUs. They just print paper to me as if they had much gold, which they didn't actually have, because they wanted weapons for the Second World War. So that backfired. And in early 19th century, that was what gave rise to this electronic means of currencies of nations fighting against each other. So they now put currency of one nation against the other nation. So your worth is determined by how much of demand. So the law of demand and supply now guides what is the rate, how much your currency is in need or not. So that was what was happening. That was what happened in the 19th century, but through the use of electronics. Then you now have big banks, banks of England, in the US, and all of that coming in. Big shots, money bags were involved until later in the 19th century, which paved way for retailers like myself and you to make use of our mobile app, to make use of our computer or laptops to trade forex. Before then, it was meant for big boys, or you have your brokers, on this large screen looking at exchanges and all of that. But now we have opportunity of trading forex. Forex is very huge, very, very huge, and is the biggest market in the old world. Far, far bigger than the stock exchange. The stock exchange runs into billions, maybe over 500, close to 1 trillion US dollar. But currently, Forex, we have well over 7 trillion US dollar being exchanged in the market every day. So there is no way, if you're a trader, that you can control what is happening in the market. Your money is just like a drop of water in an ocean in Forex. Some used this pictogram or diagram of a bear and a bull, standing against each other, competing for supremacy. So that is what happens between currencies of nation now. Now, the business of forex trading, you don't need too much of money to trade forex now as it used to be. You can trade with as little as $200. In Nigeria, which is our nation with its own peculiarity, there's many people, about 70 to 80% of people are below the poverty line. How many people can actually pull off $200? Their worth is less than that in a month. So if you can still lay hold on $50 with all discipline and with the right techniques, you can still make something out of it. To be successful in trading forex, you have to commit time. You need time. You need nothing less than 3 to 6 hours every day devoted for training, to study, to know how to do forex. You don't need employees, you don't need office, you don't need inventory before you can do forex. And another good thing about it is that it is recession proof. Now that the whole world is in global recession, forex is recession proof. To succeed, you must be willing to work very hard and master the required professional skill to succeed. The business of forex trading it is a 24 hours market, which gives flexibility. So anywhere you are in the world, you can build your business from anywhere. You can do Forex. In Nigeria, in the US, in the UK, in the Caribbean, anywhere you are in the world, in the part of the globe, you can actually do your business of Forex. You can travel from Nigeria to UK, and you will still have your account and your laptop or your Android phone with you. You are doing your business. You are traveling in the train or tram, as in the UK, you are doing your business of Forex. So you have to plan your daily routine or daily trading routine around your job if you have a job. Some people are teachers in the secondary school, in the primary school, in the university. Some people are even professionals like engineers, doctors. Very soon we'll get to the kind of trading or being the kind of traders that we have in Forex. So you have to look at the traders and tell yourself which trader you want to be like, or the kind of trading you want to use that suits your job. The hallmark of what you have to do is to generate consistent profits. Forex is so volatile and it requires a lot of discipline. If consistently you begin to lose, sooner or later your account will hit zero. But if you learn very well and you are not greedy, you're not using or engaging too much of your money in a wrong way to trade Forex, and that you are at least having close to 70-90% winning at all times. If you tell yourself you're not going to lose, there's nothing like it in the Forex. In Forex, there are some trades that you know that you just have to get out of this trade because it's already going bad. But at least once you limit that to winning about 90% of your trades, you are good. So in Forex, you can actually trade in such a way that you have 5 to 20% of return, which is profit, every month. So people can actually do more than that. Some people can do 25% to 50% every month. Some that are aggressive, that they know what they are doing, maybe they can do far more than that. But you can decently make 5% to 20% in a month of your return. Forex market, we have 4 major markets. We have the first market is Sydney market. That's the first market that opens in the day. And the next one that opens is the Tokyo market, which is in Asia. The third market that opens is London market. And the last for the day is New York market. So the times you have depends on where your location is. If you're using GMT or prime time or whatever time that you are using, or meridian or whatever. But if you are in Africa, like Nigeria, like the Sydney market opens around 10 p.m. Nigeria time, which is 6 GMT. So in the morning, 6 GMT in the morning, but 10 p.m. Nigerian time, and extends till around about 6 o'clock in the morning. Tokyo market opens 2 hours after the Sydney market, which is around 12 midnight Nigerian time, which is about 8 GMT, and extend till like 8 o'clock in the morning. Around 8 o'clock in the morning, the London section opens and runs till about 5 p.m., which is 12 p.m. GMT. So about 5 p.m. Nigerian time. The New York section opens around 2 p.m. in the afternoon in Nigeria and runs till 9 p.m. So if you now look at it, the market runs 24 hours. So the first market that opens around 10 p.m. and the last market is New York, which closes around 9 p.m. on Friday. So on Sunday, that's the first market that opens is on Sunday, 10 p.m. on Sunday, and closes 6 a.m. Monday morning. That's Sydney. I'm going over it. Tokyo in Nigeria opens around 12 midnight and closes around 8 in the morning. The London session opens 8 in the morning and closes around 5 o'clock in the evening. The New York session opens around 2 o'clock and closes around 9 p.m. Now, if you notice, there are times of overlap between the sessions. 2 hours after the Sydney session opens, you have an overlap here between the Tokyo and the Sydney. Almost about an hour that the Tokyo opens, which is around 11. It opens around 12 o'clock. So around 1 o'clock, 2 o'clock in the middle of the night, we can witness some volatility because the market is just opening here. So within 30 minutes, 1 hour, there is a volatility because of the overlap. And again, just about Sydney market closing around 5-6 o'clock in the morning, there could be some volatility that is noticed. That means increased volume, increased volatility, increased activity, But in between, or early as it opens, not much movement, and early in the Tokyo opening, not much movement, but about 30 minutes, 1 hour after Tokyo opens, you could notice increased activity. And also just before the Sydney session closes, around 5 o'clock, 6 o'clock, there could be increased activity. So we'll see big waves, movement in the market. Sydney is the smallest market, followed by Tokyo. The biggest market is the London section, then the New York sections. So again, here we notice that there's an overlap in the morning, 8 o'clock, when the Tokyo is closing and the London section is opening. We can notice some spikes here also early in the morning, between 7 and 8 o'clock or thereabouts. So there is movement. Then thereafter, the market becomes quiet again. Until around shortly before 1 o'clock, around 1 o'clock to 2, you begin to notice big movement again when the New York session is about opening and when it opens. So you see big movement at the beginning of the New York session, and when the London session is about closing. At this point also, around 4 o'clock, 5 o'clock in the evening, you notice big movement in the market. And thereafter, towards the end of the New York, it slows down again until about the time the Sydney is opening. That is the way the market functions. Now, basic Forex. Forex basics are usually each currency is represented by 3-letter code. And we have major currencies, we have minor currencies. These are the examples of major currency pairs that we know, which includes the euro, written as EUR, euro, and this is US dollar, USD. British pound is written as GBP, Japanese yen also it's JPY, and Swiss francs, Australian dollar, Canadian dollar, and New Zealand dollars. These are common types, common ones. And usually any currency pairs that has US dollar in it or pounds in it, usually or euro in it, they are major currency pairs. There are other smaller country pairs like Swedish krona, which is SEK, and DKK, Danish krone, Norwegian krone, which is, and Singapore dollar, South African rands, which is ZAR. We have that. So, but most successful traders only trade most common and liquid pairs, which are major pairs. Like Euro USD is a major pairs, GBP USD is a major pairs, USD JPY, USD CHF, and AUD USD, which is Australian dollar against US dollar. Then we have New Zealand dollar here against US dollar, or US dollar against Canadian dollar, which is USD against CAD. These are 7 pairs that are very liquid in terms of volume of trades and exchange that occurs. And again, I want to warn anybody trading also to run away from what we call correlated pairs. Correlated pairs are pairs that they are more or less the same way, they move the same way. For instance, you could have JBP USD, the British pounds against US dollar, and again you could have British pounds against Japanese yen. You could have British pounds against Swiss franc. When you have that, you have pounds and pounds and pounds against US dollar against yen and Swiss francs. They are correlated pairs. They're likely to move the same way. So anything that happens to one is likely to happen to all. And in case there is news affecting one pair, is going to affect all of them across, and you can lose your money because you are trading these correlated pairs. So you have to run away from them. So you split them. So if you likewise, if you are doing pounds US dollar and euro US dollar, they are also correlated because they are European currencies. They are likely to move the same way. So why don't you take, for instance, pounds yen, which is different from USD yen. Pounds yen, which is different from USD yen. So you have to look for how to trade. And again, you don't trade too many pairs. Don't do more than 3 to 5 pairs. Once they are liquid pairs, they will always move. And you need this to follow the history, to get acquainted and used to these currency pairs. And once you know their history, their antecedent, and the way they move, the better for you than just jumping on a pair or what you don't even know anything about because you want money. You can lose money in the process. Now, the exchange rates, the currency exchange rates, like usually they are written like this. Like for instance, in this diagram you have euro against US dollar. The euro is a currency base, and where you have the USD as a code currency. So the currency you have on your left is the currency base, and the one on your right is a code currency. Now, how does this work? Usually, if this one gains momentum, and the currency on the left usually will buy. So if it gains momentum, it's going to buy. The currency on the right, which is the code currency, if it gains momentum, it will sell. So the right currency usually sells, the left currency usually buys if they gain momentum. So the one that has the highest momentum pulls the market in its direction. But usually the base currency is quoted as 1, whereby the code currency is quoted as in terms of, or as a fraction of the base currency. For instance, in this place you see euro representing 1 and the USD being 1.3502. So it means that if you want to exchange euro for USD, you will need 1.3505 of USD for 1 euro. And likewise, if you want to sell USD, and you will sell USD, and whoever wants to buy, if euro wants to buy USD, euro is going to give you 1 for what equals to this. Now, this is the way they are quoted on the price chart. Usually our movement is in 4 decimal places. So if you move, because the movement, which is the pip movement, we call it price action point, which is pip. The pip is nothing but price or incident point. Means that for every move in the market, it is measured of a pip. So to count, you move, this is what as 1 and 2 and 3 and 4. So the first 4 decimal places is measured in pips. Like you can say that this one is from here to here is 3,502 pips, and the last digit you behind of it, which is the 5th one, is the pipette, which is or fractional pip, which is usually we don't regard it. We deal with the 4 decimal digits, 4 decimal places digits, which is 3505. So how do we calculate Forex pip? How do we calculate Forex pip? For instance, assuming that in this particular diagram, you can see that the wave is coming from up down here. So if it's coming down and the traction is down, and we have Euro USD, what has gained power is the USD to pull the price down, because the price is sliding down, which means Euro USD is having a whole lot of power. I mean, USD is having a whole lot of power against Euro in this place. So assuming the price started from here, which is, as you can see, 1.3560, and you exit at this point, which is 1.3520. So we want to see, okay, what's the difference between here and here? So you deduct 3520 from 3560. So what you have is 40. So, and that is nothing but 40 pips. So I'm still going to talk about this very soon, how we got to this 10. So, but that represents a standard lot size. So, but that is 40 pips movement that you see. So, but if that is when you are selling, if it's the other way around, and what you are doing is to buy, you can see from here it's moving towards this side. For it to buy, it's moving up. That means it's the euro that has power over USD. That means if you start buying from here and at this price, and you exit here, you want to sell at this point, you want to cash out at this point, you look at how many pips different. So you deduct 3510 from here, it gives you 40 pips. That is how we look at the market. So is the number of pips against whatever value that you will use to calculate your reward. Now, let me talk briefly about what we call the lot sizes. Lot sizes is nothing but the fraction of the money of your money in the market that is being traded. The fraction of your money in the market has been traded. For instance, every base currency is quoted as 1, which is one standard lot, which is 100,000 lot size. 100,000 lot size. That is what it means, 100,000, and like here 100, like GBP 100. So every of these, the standard lot is actually 100, which is one standard lot equals 100,000. So as you can see here, of the base currency, one standard lot is 100,000 of the base currency. So, and if you want a tenth of that, which is 0.1 of standard lot, will be 10,000 of the base currency. 0.1 of the standard lot will be 10,000 of the base currency. Let me get to the second diagram that will help us see what I'm trying to say, like here now. So standard lot is 1,000. A tenth of this is 10,000, which is mini lots. So what we use in the trading lot size for standard lot is 1. So which means 1 represents this one, and this one 0.1 is this, which is 10,000, and micro is 0.01, which is 1,000. We don't do this one anymore. So your account cannot handle this trade. Nobody will take it. But the least you can do is a 0.01 of 1,000 units, or 0.1 or 1. When you use a lot size of 1 and you are dealing with Euro USD, what does it mean? It means that for every pip, when you use this, it means that for every pip on Euro USD, for every pip movement, $10 of your money is involved. If you use 0.1 of the standard lot, which is 10,000, instead of $10, it means $1 of your money is being traded, is involved per pip. And here, which is 1,000 units, it means that 0.1 of your dollar, $0.1 is involved in this micro. So it's good that we understand that very well. And this is what I've put here in it, 1,000 and a pip, what it could mean, as you can see in this diagram. Now, let's talk briefly of the 4 kinds of forex traders that we have. We have the scalpers. The scalpers are the ones that want to go into the trade briefly. They only need 5 to 10 pips per trade, and the time duration that they want to do that trade for is for seconds to minutes. You don't trade for 1 hour, for between seconds to minutes, less than 1 hour, and the chart that they use is 1 minute to 5 minutes charts, and they want to just get 5 to 10 pips, and they can do several of that, maybe about 10 of that in a day. If they have the time, that means they don't have any other work. The second one, they are the day traders. They target 20 to 40 pips per trade. Day trader, that means within a day, within 24 hours, they want to target 20 to 40 pips and get out. On daily basis, they want to cash in 20 to 40 pips. And the chart they use 15 minutes, 1 hour to 4 hours chart. Now we now have the swing trader. The swing trader are the ones that actually wants to do 50 to 150 pips per trade, and their trades could take maybe less than a week or thereabouts. And most of the time, the chart they use is 1 hour to 4 hours chart. Then you have the position traders that target between 500 to 1,000 pips, and the trade duration could go to weeks to months. And usually they use the daily and the weekly candle to chart. Some people do a fusion, like myself. I do a fusion of swing trade and position trades. Because of my work, I'm a doctor, and I work in see patients and all of that. I don't have time to do daily or scalping, and I don't have that time. So I work to, if I can get 200 pips, I can get 1,000 pips or more. You know, I go for within in a month. I go for that. I could get as much as 2,000 pips at times. Between 600 and 2,000 pips is okay for me. That is what I do. So you must know the kind of trader you want to be: a swing trader, or position trader, or scalpers if you don't have any other thing, or day trader. You have to learn how to use your chart very well. So, having said this brings us to the end of the first training video here. Thank you. Oh, before I actually go to the end of it, I would like to talk about this particular currency pairs. For all currency pairs that exist, to calculate their pips, they are into 4 decimal places. But any currency pairs that involve the Asian, which is the Japanese yen, they are actually into 2 decimal places. You can have 3 numbers at the end of the point, but to calculate the pips is into 2 decimal places, and we use the same way we calculate for the normal regular pips for the currency pairs that has a yen in it. Thank you very much.